Market mechanics. This topic is the fundamental one in understanding any market. This is like the basement of the house, and the stronger it is, the better you will apply all this knowledge on the practice. The very plot of our course is not to teach you trading by templates, as it's absolutely wrong and mindless. This topic will help you not to see what is happening in the market, but what are the mechanics of the market, how it works, and you will understand it and see the liquidity and participants. You will differ from those who trade graphs and indicators. The truth is that only 3 participants could earn on the highly manipulated market. Exchanges by charging fees, huge players by manipulating small players, and those who can see huge players and trade with them and not against. All other participants are losing money right now or in long-run perspective, receiving from the market nothing but disappointment. This course will not make you a huge player, but the third participant who can see the huge ones and profit with them. What is most important is understanding the basic mechanics of any market. On any market, we have only 4 participants: market buyers, market sellers, and limit buyers and sellers, as you see. Quite simple. Let's see what are the mission of each of them. Representation of limit and market participants are shown here. Here we see the market participants, those who are satisfied with the current price of the instrument and buying or selling by the market right now, by the current prices. The representation of their orders we see here. Red ticks show us volume of sales every moment live, and green show us the purchase made by market buyers who are buying right now at this moment. The faster this part is moving, the higher is the activity of market participants. Let's see again. Here we see market participants. Limit participants are shown here. Let's look at this in the order book. Here we see futures section. Here we see spot section. Here the ticks are displayed green of the market buyers, red of the market sellers. The activity now is quite low. In this part in order book we see limit orders of the limit participants. Buyers in green zone and sellers in the red one. Such participants are waiting for their limit orders to be executed. They are static and they are waiting for market participants who will execute the limit orders. Limit participants are those who do not want to open the trade by the market, but they book the price where they want to open the trade, sell or buy, and they are placing those limit orders waiting for execution. These sellers placed 13,000 contracts here at the price 4.506, don't want to sell by current price. They want to sell from that price. That's why they are not selling right now by market. They would like to sell for higher prices. In all exchanges, the execution of limit orders could be made only by market participants. Let's imagine that the exchange is a building to where limit order A calls in advance to ask to place his 100 contracts for sale. Let's imagine that the exchange is a building to where a limit participant A calls in advance and asks to place his 100 contracts for sale at a stipulated price of $10. He is waiting when the exchange workers place this order and find a market participant B who comes to exchange to satisfy his order. Finally, workers call the A limit participant. He comes to the exchange building. He is waiting in one room where limit participants are waiting for their market counterparts. And market participant B comes to another room where he don't have time to wait and is ready to open the order buying the instrument right now. At current prices, the price now is located on where the limit participant A wanted to place his limit order. market participant B is agreed with such price, $10. And he, let's say, buys out 80 contracts from B. He executes 80 out of 100 contracts of the limit order. The price is still at the same level. The A participant is still unsatisfied as 20 contracts left for sale. The next market buyer, C, comes and wants to buy 200 contracts at current prices of $10. He executes 20 contracts left from A participant, who is now satisfied as he sold out all the contracts, 100 units at $10 price. But now there is no liquidity left at $10 price level for market buyer C. He bought only 20 and 180 left to buy according to his demand. The price grows by 1 point to $10.1, where another limit order placed 120 contracts for sale. Market buyer C buys out 120 contracts more, but not at $10, by $10.1, and 60 contracts are still unsatisfied. He needs 60 contracts more to buy. No liquidity again at 10.1. Price goes higher, 10.2, where 400 contracts are placed by limit participants for sale. The next limit participant. Now the C participant market buyer finally satisfies his demand totally, buying 100 contracts at market prices, namely 20 contracts at the price $10, then 120 contracts for $10.1, and 60 contracts at the price $10.2. However, to make price goes higher, the next market participants have to execute the left part from those 400 contracts placed above. 340 now, as C participants bought out 60 contracts from it. If there is a lack of such buyers, the price will rebound from this level, from that huge limit order, and go down. C participant will bear loss. If there is enough activity of market buyers, enough demand at current prices, they buy out 340 contracts left and price continues to grow. That's how it works. That's it. We make a conclusion that market participants push the price while limit orders are resisting the price. The higher the activity of the market participants, the higher the probability that the next limit order will be executed or broken. The higher the limit order and lower the activity of the market participants, the higher probability that such a limit order will withstand, stop and reverse the price back. Huge limit orders are usually placed around strong levels where participants fix their long positions, for example, and open short positions to catch pullback from level. When the activity is too high, market participants drastically, very quickly execute these orders and the breakout of the level is occurred. When they are weak and the limit order is solid resistance for current market participants' activity, we see the pullback from this level and from these limit orders. When we are talking about market participants, buyers or sellers who are pushing the price by selling or buying at current prices, they are usually called liquidity grabbers. Those who, let's say, consume liquidity. They are coming to exchanges as customers and the commission for trades opened by market, but by current prices, are usually higher. When you open the trade through placing limit order, you are a liquidity provider. Placing a limit order, you are assisting the exchange. The higher the liquidity at the exchange, the more reliable it is. When a lot of people, a lot of participants placing limit orders, the liquidity of the exchange is growing. Like Binance Exchange, it's always full of liquidity on most instruments, and you hardly face empty order books like we can meet on other exchanges. That's why when you enter the market with a limit order, it will be cheaper. Let's check it on the Binance. Here we see the table for spot trading. Let's see USDM futures trading. For regular user, for maker taker, in USDT, we have 0.018% from each trade. And for a taker, for those who enter by the market by at current prices, 0.036% from each position, 2 times higher than of maker. As you see, all this process is like Pac-Man game. Pac-Man is a market participant who has to execute limit orders to move further. However, the Pac-Man always has enough activity to move, but market participants always have the activity or potential. We can treat some limit orders as very huge today, according to the current market activity that we watch here, quite weak and slow. And tomorrow, as you see, the same limit orders and even much bigger limit orders will be very unreliable as the capital shifted to that instruments, bringing a lot of participants. Market participants' activity increases and they have enough power to break or execute such limit orders. As you see, activity here is very high. Executing quite large limit orders within a few seconds. Extremely high activity. Let's summarize. To let price go at least for 1 point up or down, the limit order on its way should be executed by market order. Limit participants can't be brought together as well as market participants. When you place limit buy, you need market seller of the same volume. When you place limit sell order, you need market buyer to execute it of the same volume, and vice versa. That's what is happening in the order book when the activity is quite high. Market participants attack the limit orders that resist them, like a wall. It's like assaulting side and defending side. And who will win this fight depends on who is stronger. Limit orders or activity of market participants, buyers or sellers. That's how it's look like in the order book. Let's try to transfer all these mechanics right to the graph. Let's imagine we are watching what is happening on the city market where people come to buy fruits, vegetables, grocery. Several people visit market to buy apples. They are searching for the seller. There is only one seller. They find him and find out that he has 100 apples. 100 apples for sale. 10 people buy out 10 apples and satisfy their demand. They are partially execute the limit order. They go away and the seller has 90 apples unreleased for sale. The buyer's demand is decreasing. Everyone has bought what he wanted. The supply exceeds the demand. The price is going down. The limit order is only 10% executed. So the supply exceeds the demand, the price is going down. Simple supply-demand rule from school economics. The buyer's demand was too weak to buy out all this supply. So the price is going down, down. Finally, when the price has become quite low for current state of the market, here we see the buyers, those who perceive current prices to be good enough. The demand here is growing, but we remember that our buyers who bought 10 apples are selling them here to fix profit. Remember report trades from the previous videos. Let's imagine apples are speculative assets. The buyers here place their demand for apples that are cheap enough to buy them and sell higher, somewhere here. But we have only 10 sellers with 1 apple each and 100 buyers here in this buy limit order. The buyer's demand is satisfied partially as well here, and the price is reversing to grow because demand now is exceeding the supply. The buyers need 90 more apples. So the apples now in deficit for such a low price, and buyers who want to buy it are searching the assets for the prices higher, executing sellers' limit orders on that prices. We imagine the situation when a lot of people rushed to the market searching for apples, as tomorrow is an apple holiday, for example. Here we see the seller's limit order with 300 apples for sale. The sellers analyzed the market and prepared well. Yesterday, they resisted the price, placing 100 apples for sale and reversed the price. Today, they are expecting the same situation in order to get profited, selling here and buying somewhere here. Remember again, report trade from previous videos. But they were wrong, describing the situation from the trading analysis and crowd psychological point of view. The participants of the market are watching the market. They are switching between the instruments, and finally they see such a range here. And the Bitcoin is growing as well, for example. They see as well all these factors. And this range is perceived as a pattern where finally will be the breakout. The capital flows into this instrument, increasing the activity. And now we have 1,000 buyers who want Apple to buy and break this range, selling apples much higher somewhere here. So activity is extremely growing. And finally, 1,000 buyers rush and buy out 300 apples in a few seconds, executing all this volume. They are rushing to another market where they are buying out other sellers' limit orders for higher prices. They are buying out them, satisfying the demand. Those small sellers' limit orders can't resist such an activity, such a rush of market buyers. The buyers are rushing to another markets where they buy out apples for higher prices till all the demand is satisfied. Finally, here we see another huge seller's limit order, or several huge limit orders that resist the market buyers' power and absorb their pushing power. They again lack power to buy out all the supply provided at that price, as they lost their potential and power on that way, on that impulse. Because many of participants were fixing their position somewhere here, somewhere here, and all that impulse was losing power. The higher this impulse reaches, the less power it has, because many participants are fixing and go away. However, all that way, market buyers had to execute all these limit orders in order to get higher. Here they faced solid resistance, executed it by 1%, let's imagine, and totally lost their power. Finally, 1,000 apples demand is satisfied somewhere here, and price is rolling in, getting back. Where new participants who missed the opportunity to buy the instruments before the breakout buy the instruments here again, and the price is reversing back again, assaulting this limit order with a new power. What we see finally, we scrutinized the process from the inside, but on the graph it's visible as the range where the price is accumulating power. We see the breakout, retest, and movement continuation. But this model is maximum simplified. To make the mechanics clear, we don't consider many factors like market makers or huge players who are loading positions inside this range. However, all these elements don't change the plot of the mechanics. This is the real example of the range on the real graph. Look at this, how it works out. I hope everything is clear for you here. If not, please write us if you have any questions and watch this video again to make it clear, as this information is extremely important to understand to go further.